Good morning and welcome to the Orlando Real Estate Buzz. I'm Brendan Rendo with the Homes in Orlando team, joined as always by Joseph Dion of the Aptly Home Loans. And nice day out. I'm enjoying this little bit of cooler weather here.
Ooh, cool. Like it reminds you of the north, doesn't it?
Yes, it does. Yeah, it feels like early autumn when you start to wake up and got a little crispness in the air.
That's awesome. It's gonna feel like summer again in a week, but let's enjoy it.
I'm enjoying it while it's happening. Well, we got a lot of stuff to go over this today because so much came out in so many directions about the mortgage industry. I mean, we got smacked with 50-year mortgages over the weekend, changing the assumable mortgages, and possible portability as well coming out. And then Fannie Mae has, quote, done away with credit scores as well. Yeah. So, I mean, just a lot of news on the mortgage front, and the whole thing is coming down to affordability, trying to find solutions for affordability. Mm-hmm. And hopefully we can find them. So let's take a minute. Welcome again to the Orlando Real Estate Buzz. So, Joe, this weekend, Trump came out, sent out a tweet about 50-year mortgages. And I kind of caught it on Fox News. And this was Kevin Hassett, who's one of his economic advisors.
Mortgage. Mm-hmm. I've heard, I just was watching a panel on the previous hour, basically saying, they didn't think it was a great idea because you don't build equity and you pay more over a long period of time. Do you think this is a good plan? Is Kevin Hassett a supporter of a 50-year mortgage plan?
Right. The president mentioned it, and yes, I support the president's idea on this, that what it does is it reduces the monthly payment quite a bit for a typical home for middle America, and it's by a few $100s a month. And we need to help people get back into homes. As you notice, the first-time home buyers are now like over 40 years old, and so we are focusing on that problem. And the bottom line is, though, that the problem really again came because interest rates under Biden inflation went up by 4%. And that about doubled the typical monthly mortgage payment. And we're really studying everything we can. We're about to have a bunch of White House meetings about what we can do.
Isn't the problem that there's not enough houses, there's not enough housing to purchase, so there's a limited supply, and that doesn't really address that.
Demand. You're right. We're addressing both supply and demand as we study this. There'll be more to announce soon, but housing has been one of the top policy things that we've been studying the last few weeks.
All right.
So what do you think about what he says there?
I think it's a little bullshit. I don't know.
Thank you. I wasn't the only one, huh?
I feel like they threw around this thing of like, oh, we'll do a 50-year mortgage, and they were hoping for a lot of positive response, but I don't think people want to be handcuffed to.
They got hammered.
Debt.
They have been hammered the past several days.
And I think because of that, I think we're going to go away from it. Like they tried to press it as a good thing, and it's going to save money, and it's going to do this. But like the reality is like when you go into the specifics, let's assume, right? And I know you're throwing a graph on another, but let's just assume the rate stays the same from a 30 to a 50-year.
Yeah.
You'd save about, I don't know, on a $400K loan, let's say 36.25%. 30-year would be principal interest $24.63. For 50-year would be $21.80. That's a savings. Like it makes it a little bit more affordable, right?
Yep.
But we all know, like, do we really think that the rates, because the rate on a 30-year is worse than the rate on a 15-year?
Yep.
Like, do we really think that they're going to extrapolate from a 30 to a 50? So another 20 years. They wanted more interest to take a 15-year note and add 15 years to it. Yeah. So 20 years, I would expect an even bigger percentage. So I think reality, if it actually ever happened, your rate, would be 0.5% to 0.75% worse, and you'd be saving $100, maybe.
Yeah.
A month.
I agree with you wholeheartedly. Because that's something no one talked about is, would the interest rate stay the same? Well, of course it's not going to stay the same. And just like you said, 15-year rate is different than a 30-year rate. And when you start looking at it and you actually look at the amortization schedule, I did this chart just to get a rough idea. And look at the green one is your cumulative interest. Look at this. And everyone says, well, people only keep their 30-year mortgages on average for 8 years. Okay, that's
changed.
fine.
It's now 11 to 12 years is what they're estimating.
Yeah. So let's look at this little yellow line. This is your remaining balance. And look at the first 10 years. You pay nothing.
Well, I mean, let's just take on a 30-year note. How many people have bought a home in the first 30, and then after year one, they get that tax form that shows them what they paid, and they see that big interest number, and then they see the tiny little principal number.
Yeah.
It'd be even smaller on a 50. I mean, you'd be putting what, 10, 20 bucks a month toward principal?
Yeah. I looked at, I actually ran an amortization schedule for the 50-year. And the first year on a $300,000 loan, you would pay $1,000 towards the principal.
I like it.
$1,000.
But you're gaining appreciation.
Yeah. Now here's your question. You need to sell it after 5 years.
You haven't built enough equity.
You're going to have to come out of pocket to sell the property.
Yeah.
So it's, you sit here and it makes a great headline. Trump proposes 50-year mortgage. Some say homeowner savings will be minimal. Well, everybody should be saying that. Mm-hmm. Everybody should be looking at it. And the way I looked at it is, man, here we go, is you might as well just be a permanent renter at that point, because you're never going to own the home. I'm sorry, if I'm 20 years old buying a home and I'm going to pay it off when I'm 70.
I think for the, and let's be real, I think for the right person, there might be it could possibly make sense. Have to be very fiscally sound, have to know what they were doing for their money, have to be willing to sit there and say, hey, that $200 monthly savings, I'm going to put over here and do this and that. But the reality is, and let's go into America is still I think this helps us with home ownership and the American dream and all that fun stuff. 30-year mortgage that's an American thing.
It is. And it was interesting because Coldwell Banker just came out with their American Dream Report. And this really kind of, it sums it up in a lot of ways. Here it is 85% of Americans believe home ownership is still part of the American dream.
That's good.
That's wonderful. That's what I thought with all the fiscal stuff going on, that a lot of people, and you hear about Generation, Z saying, we're never going to own homes. We're never going to own homes, but they want to. That's the thing. They want to own homes. So we've got to help them figure out ways that they can own homes, but here's the other thing is you look at 71% of aspiring homeowners. What are they doing? They're starting to delay a lot of things in their life so they can buy a home. They're saying they're delaying marriage. They're delaying having kids. They're delaying making career moves.
Retiring by 67. I like that one.
Yeah. It's so there's a lot of, there's so much anxiety out there. Everybody, I still, and I truly believe it. I believe that number, that 86% of people believe, that they want to own a home. It's just what it is you look at the cost, and, Kevin Hassett mentioned, Biden rates went up 4%. Well, that's just part of it. The other part is we had housing inflation that really, when you look at it, was 100%. When you've got a house going from $200,000 to $400,000 overnight, that's 100% inflation, right?
Yeah.
So, and then you look at the CPI numbers and you're saying, well, inflation's just up 9%. Why don't you actually put everything in there so we get some real honest numbers for once from you guys?
Yeah, there's a lot to go. And you mentioned the American dream and those, it's tough because, what do they put? Federal Reserve consistently puts out net worth is roughly 40 times that of a renter for a homeowner to a renter. It is interesting. I think a lot of people still see there's more millionaires made from home ownership and this and that, but a lot of that is it's the tangible of what you're saying is how many people became millionaires because they bought the home for $100,000 and it's now worth 1.2 because they've lived in it for 30 years.
Yep.
is that same thing going to happen with people buying their first home this year? I don't know. Like, are $400,000 homes going to be worth $3 million in 30 years?
I'll tell you what, the way things are going, probably, the way they're deflating the value of everything. I kind of wouldn't doubt it, but it's interesting because they got so much blowback. Much blowback from this. Then you see, Pulte coming back out and he tweeted a couple things out after the 50-year mortgage. One of them is changing the way we do assumable mortgages.
So tell me a little bit about this, because we know what assumable is, like you're taking over somebody else's. Portable is interesting for me because that's like saying, hey, I can take my existing mortgage and move it from one house to another house.
Yep.
That's interesting. The assumable has always been kind of gimmicky for me because you can't, one, you got to qualify. Two, the companies that have those notes don't really, they're not putting teams together and being like, we're going to do this really fast for people. And three, you typically can't get, you assume the existing note. Well, if the house appreciated 100,000 and you're buying it for 100K more than the mortgage, then you got to figure that out. And usually you got to bring cash.
Yep.
And most people don't have that. So I feel like that's gimmicky. The portable, also gimmicky, but interesting.
Well, yeah, I did not know, and I'm going to do some research on this week. Maybe we can come back with a little segment next week. Is apparently it's done quite often in the UK.
Okay,
it's actually done in the UK. So I didn't have time to do a lot of research on it. So I'm going to have to find out exactly how they do it. But here's the problem: is how would you go back and retroactively make the current mortgages that are 2.5-3% portable? You think these banks are going to want to say, okay, yeah, we'll just do it out of the kindness of our hearts because we really don't want to originate any more loans because that's where we really make our money.
That's the key right there. Is no bank is going to sit there and be like, wait, I'm good with this whole portable. Let's keep these 2.5 interest rate loans on our books even longer. They're all like their books, right? They want people to feel confident in the market and buy and give up those rates because, hey, right now it's like you can borrow at 6 or 6.5 or 5.5, wherever you are, right? But it's double to 3 times more than what a lot of these people were before. They're not looking to want to move that. So I think, like you said, if anything that does happen, I think we see it being moving forward, and it'll probably be we can't retro. We can only do it from this point forward. I mean, they could retro. They could be like, well, we're just going to release this lien on this property and put it and move the existing mortgage to the new. Like, they could do that, but there's no incentive, like you said.
No.
Why would they do that when right now they can go, well, if they sold and bought new, we go from 2.5 to 6.5 interest. 6.5. Now we're collecting.
Yeah. It just, sometimes people I think they're floating a lot of things out there right now just to try and get some feedback, get some feel, see what positive they can get back and what blowback will. They got plenty of blowback on the 50-year mortgage. Well, I really, really don't see that happening. But the other interesting thing that came out that he mentioned too, and I think this is a stimulus because the economy is much worse than what they're floating out there right now, is that $2,000 tariff dividend. Oh, everybody's going to get $2,000. Oh, yay. It's like, okay, why are you doing that? Why not just stop borrowing as much money? And I truly believe when you start looking at the debt situation that we looked at last week, and you're seeing the number of delinquencies on car payments, how many subprime car lenders have gone out of business in the past month? 3? Yeah. Right. There's been a couple hedge funds in the past couple days that went under. So
that one kind of shocks me. I'm not sure how hedge funds are going under right now.
So you're seeing the number of bankruptcies starting to shoot up quite a bit. So what have other presidents done in the past? I kind of remember Bush. We got like $450 or something like that. Stupid, right? So what do? Well, you throw the cash into the system to give it a little bit of a boost, right? Maybe help delay some of these bankruptcies and some, get some of these people caught up on some of their bills. So that that one, I'm kind of like, what are you doing? So I keep thinking about that one as well. And then the other thing that came out, I mean, just mortgage news all over the place is, quote, Fannie Mae scraps the minimum credit score for DU loans. You got to explain this one to me.
Okay. Well, like, it's kind of a little bit of smoke and mirrors. No, there's not.
Are you kidding?
No. So we've all heard about the new scoring model that's going to be coming out, right? The competitor to the tri-merge, FICO, that whole, right? So there's a new scoring model which has a different scoring system, and it's getting introduced into the mortgages, which is all great news, right? Like, it's another competitor. It's going to help potentially stabilize pricings for credit, bring down those costs, this and that. Well, the problem is everybody was like, well, how do we, like, DU requires a 620 credit score, but the scoring model doesn't use the same thing. So how do we do this? So AUS, the automated underwriting system, they were like, Fannie Mae was like, well, we'll just get rid of it. Like, we don't need it. The only thing that they used it was literally just a number. Like, if the credit was below it, like, it wouldn't approve it for conventional, right?
Okay.
Now, this is where I kind of say, like, it has a purpose. They had to get rid of it to allow this other scoring model. This is how they're going to enter. But the reality is that if you have a borrower with a 620 credit score, are you going conventional anyways? Like, on a primary, you're typically going FHA because of credit, right? We get rid of it. Like, and really the other side part is, like, that borrower on conventional typically isn't getting approved at a 620. They're probably not getting approved at a 640 credit score, right? Because what they've done to get that credit score, like, conventional side doesn't like. So if you go even lower, it's utilizing, like, we don't need a score number at all, because reality is they're looking at the credit report, and what you did to get a lower score is probably going to make you ineligible for an automated approval anyways. So it didn't really matter. And then I think the secondary piece is, now we're going to let lenders, like, what we'll end up seeing eventually is, like, well, we'll see what lenders, how they handle and mitigate it, because if they don't want say a 590 conventional loan that got an approved eligible, they're just going to add a loan level price adjustment to that sub 600 credit score that says, hey, it's going to cost you 3% on top of your rate and cost. So, they're basically going to push you out of the market,
push you into the FHA market.
Like, and I think, is it strategic? Was it necessary to allow some changes to the marketplace for additional scoring models to create competition on the credit side? Yes. Is it going to impact day-to-day mortgages? No. Like, I've seen a lot of mortgage, like, loan originators and brokers and realtors tout this, and I think reality is this is kind of it doesn't matter.
Yeah, I agree with you wholeheartedly. Nothing recently has made it any easier to get a mortgage, and I think that a lot of it goes back to all the problems we had in 2007 and the Great Recession. They're still going to keep it realistic. We've been there, we've done that, where we've taken the people. I remember 580 credit score got you 100% stated income loan. I mean, I remember that. I mean, getting this is how old I am. The fax machine, every morning coming through, new program, 580, 100% stated income, and you're just like, that's stupid,
With the 90, 10, 10s, where it's like, you got even more.
Yes. Yep. The 80-20s, all that. Oh, it's better to do it this way than it is. Oh my gosh. I remember all that. So then some other interesting news, we always like to keep up with what's going on with the Fed. And we have taken a huge drop. The Fed meeting's 27 days away. So it's about 30 days, about a month away right now. Okay. And we were at roughly about 63% saying that the Fed was going to do a rate cut. We're down to 53%. We're almost 50-50 whether or not they're going to do a rate cut in December now.
I'm really curious to see, because, I mean, hey, we didn't talk about this. Like, did everything get passed? Like, House moved to pass the bill to reopen the government?
Yeah, he signed it last night, I think, or this morning.
I think, right? Like, so that means we've got a lot of economic data that's going to be pent up, that's going to hit all at the same time within the next week or so. I'm very curious to see what it all plays out.
Yeah. I saw a very interesting tweet last night that the October numbers are so bad, they may never disclose them.
The October numbers are so bad. They're trying to figure out how they can change them.
How to hide them. They're actually figuring out how to hide them because they're so bad. That's nuts. I mean, because you just think about it. Consumer confidence is at probably one of the lowest levels that's ever been in the history of doing the numbers, and you feel it out there. Mm-hmm. But interesting enough, this week I've gotten 6 calls from past associates. Hey, Brendan, thinking about the beginning of the year, starting to take a look at a house. Mm-hmm. Can you set me up with some searches? Which is kind of a nice feeling, because I wasn't expecting it. Because usually November's pretty quiet, but I've gotten a couple different calls this week on, okay, I think we're gonna move after the first of the year.
Yeah.
Which that was like, oh, thank you. Yeah. Okay, let's get started. Let's start planning for the first part of the year and see how things go. So that made me feel better. Anyways, let's get into our ORRA numbers for the week. And we took another drop, which, that's kind of typical after the end of the month, drop back down to 360 below that 400 home level mark. And our inventory decreased a little bit. Condos, same thing, drop below that 100 mark. And the inventory only decreased about 8 units. So not a big drop overall. Then we get into what we always love to see. Our months of inventory, we're sitting about 5.72, right at that 6-month mark. And then the original list to sales price, on average, we're down about $45,000. That's a good drop. That's a big drop.
Yeah.
And the interesting thing is the final list of sales price is about 16. So what it's saying is the sellers are having to drop their prices before people are making offers on them. Mm-hmm. So they're dropping more up front to get people into the houses. And we're still sitting at that on average, that 92% level right there. Mm-hmm. And look at the over 1 million. They're sitting about 92%. So still a lot of deals out there, a lot of opportunities for people. And we look at it graphically. Here it is again. There's that period average of 399, but we really are spending a lot more weeks under that 400 mark than we are above that 400 mark. And if the Fed doesn't cut, I understand. To me, I'm in a mixed bag right now, whether they should cut or they shouldn't cut. And some of the economic numbers, I'm thinking, yeah, maybe they should, at least a quarter. I'm thinking they need to do another quarter. Mm-hmm. I'm worried about the inflation number. I'm just afraid that's going to boost back up again. That's my big concern.
Yeah.
And then we see our inventory levels, our peak back in July, about 9,500. We're down now to about 8,900. And about half of that, again, is coming from people canceling their listings. Not from sales, but from canceling the listings is where about half that number is coming up from right now.
Okay. Then
we get into our condos and, sitting at roughly 11 months worth of inventory. The original list, the sales price, we're sitting right at that 91% on average across all price ranges. But look at this over 1 million. 81% somebody took about a 20% hit.
That's a hit.
That's tough. That is tough. That'd be a hard one to swallow. Yep. Hopefully they bought it well before the boom and they had some equity in it. Hopefully. So, that's where our numbers are this week. It'll be interesting to watch, I think, over the next several months, what Pulte and Trump kind of try and pull together. I don't know if any of it is actually feasible.
I think they've got. I like the fact that they're trying to come up with ideas, right? Mm-hmm. Like I think that's good. Yeah. But I do think I kind of lean more on your side. Is a lot of it does feel like it feels gimmicky.
Yeah. It just seems like they're floating things out there, trying to get people excited, get some fire in the belly of Americans. But I just think, we looked at it last week with all the debt. What is it? $18 trillion of household debt, somewhere in that ballpark right now. Mm-hmm. That until we resolve the debt issue, I don't know what solution there is.
Yeah, I think you're right.
I don't. I wish I had one, but I don't at this point. So, Well, thank you all for joining us this week. Thank you again, Joe. And please like, subscribe, and join us every Thursday for the Orlando Real Estate Buzz. Take care. God bless.